Welcome to Wealth Chapters, the channel where we break down the most powerful books on wealth, investing, and personal growth, one chapter at a time. All right, so today we're diving into chapter 9 of what is, let's be honest, an absolute masterpiece, Benjamin Graham's The Intelligent Investor. And this chapter, it's all about one of the simplest yet most powerful tools ever invented for someone like you or me, the investment fund. So let me ask you something right off the bat. How is it possible to own a piece of hundreds, maybe even thousands, of the world's biggest companies with literally just a single click? I mean, it sounds kind of like a magic trick, right? Well, the answer to that question is really the key to everything we're talking about today. Okay, to really get why this is such a game changer, we have to start with the huge problem that pretty much every single one of us faces as an investor. It is just so hard to build a truly diversified portfolio all by yourself. I mean, just think about what that would actually take. You'd have to spend countless hours, right? Researching dozens and dozens of different stocks. You'd need a ton of money to even buy a decent chunk of each one. And even if you pull all that off, trying to get the right mix to actually protect yourself from risk, well, that's a massive job in itself. It's basically a full-time gig, and one bad emotional decision could just wreck the whole thing. So, what's the solution to this huge headache? Well, this is where Benjamin Graham points us towards something that's simple, it's elegant, and it's just incredibly powerful. And that solution is the investment fund. So, what is an investment fund really? At its heart, it's super simple. It's just a company that pools money together from tons of people. People like us. Then it takes that giant pile of cash and invests it across a whole bunch of different things: stocks, bonds, you name it. And the best part? It's all handled by professionals. The best way to think about it is like a portfolio in a box. It's perfect. Instead of going out and buying dozens of separate ingredients for a recipe, you just buy the complete meal kit. You buy one thing, a single share in the fund, and boom, you instantly own a tiny piece of everything that's inside that box. It is such a brilliantly simple concept. And this, right here, is where the magic really kicks in. Right away, you get instant diversification. Your risk is spread out immediately, and you didn't have to pick a single stock. You also get professional management, which means you don't have to be glued to your screen watching the market 24/7. And maybe best of all, it's just so accessible. For just a little bit of money, you can own a piece of the entire economy. It solves all those problems we were talking about, just like that. But okay, hold on. As any intelligent investor knows, there is never a free lunch. It doesn't exist. So while these funds are an absolutely fantastic tool, there's this hidden catch, an unseen drag on your portfolio that can quietly, silently eat away at your money over time. And that hidden drag is fees. And let me tell you, Graham could not be more clear about this. He basically screams it from the rooftops. The long-term damage that costs can do to your returns it's devastating. Honestly, this might be one of the single most important lessons in the whole book. You have got to pay attention to the price tag. So every fund you look at has this annual fee. It's called an expense ratio. And you might see one that charges, say, 1.5%. I mean, on the surface, that sounds like nothing, right? It's so small, it feels insignificant. So what's the big deal? What harm can a tiny little 1.5% fee actually do? Well, this is where we see the brutal truth. Let's say you invest $10,000 and it grows at a nice 7% a year. After 30 years, you've got a really nice pile of money. But now, let's factor in that tiny 1.5% fee. It secretly drags your real return down to 5.5%. Just look at the difference on this chart. That little fee has eaten up a massive, massive chunk of what could have been yours. This is what Graham called the tyranny of compounding costs, and it is a monster. Okay, so if we know our number one mission is to keep costs as low as humanly possible, that leads us directly to the biggest choice you're going to have to make when you're picking a fund. It's the big fork in the road. Do you go with an active fund or a passive one? Let's break this down real quick. On one side, you've got active management. This is where you have a fund manager, a real person, who is actively trying to be a hero. They're picking the stocks they think are going to win and trying to beat the market. And for that effort, you pay them higher fees. On the other side, you've got passive management, often called index funds. Their goal is way simpler. They aren't trying to beat the market, they just want to match it. They just track something like the S&P 500 automatically. And because a computer can do most of the work, the costs are incredibly, incredibly low. So here's the million-dollar question, right? Are those higher fees you're paying for active management actually worth it? Well, the data, we're talking decades of data here, is pretty overwhelming. And it shows that very, very few of those active managers can consistently beat the market average over the long run, especially once you factor in the higher fees they charge you. The hard truth is, most of them end up doing worse. All right, so with all of that in mind, how do we actually use this information to build a smart, winning strategy for ourselves? Well, thankfully, Graham doesn't leave us hanging. He lays out some really clear, simple principles for success. First up, you have to define your goals. Seriously, this is your personal roadmap. If you don't know where you're going, you're just wandering around. Number two, and this is huge, minimize all costs. It's pretty much the only thing you have direct control over, and it's one of the best predictors of how well you'll do. Next, prefer simplicity. Just forget about all those flashy, complicated, trendy funds. Stick with boring, straightforward, easy to understand funds that track the whole market. And last, but this is probably the hardest one of all, maintain discipline. Your biggest enemy in investing isn't a market crash. It's you. It's your own impatience and emotion. You have to make a good plan and then have the discipline to just let it do its thing. And that really brings us to the final thought, the big question you have to ask yourself. When you look at your own investments, is your strategy built on pure speculation, just a wild hope that you'll get lucky? Or is it built on a solid foundation of timeless, intelligent principles, like the ones we've just talked about? Because honestly, the answer to that question, that could make all the difference in the world.